Yes. Awesome. Welcome, Andrea, Joao. Welcome, guys. Let's start. Let's begin. Remember our rule. Let's turn on your cameras. Let me see you guys. Come on. Sorry, I couldn't be today, guys. I couldn't go to the campus because it appears that my wife has COVID. So I'm taking care of her. Actually, when we finish, we will go to the doctor. So sorry for that, but.
And is she feeling fine? Like, did she get?
No,
like,
she's feeling
worse?
bad. She has been feeling bad since like 3 days in a row.
Oh, poor her.
And right now she is like has like a flu. So right now it made sense to us that she has COVID. So let's see. So Joao went out. So guys, oh no, Joao. So who somebody disconnected? Oh yeah, no, Emilio's here.
Yeah, but
Arturo.
my internet just
Okay.
took me back.
Awesome.
So it was me.
Perfect. So guys, let's move on. So are you watching my Excel?
Yes.
Awesome. Remember that this will be uploaded to YouTube. So there are 3 types of financial impact for the use of foreign currencies. Guys, we saw an example last class, remember? I just did a transaction of a credit sale between 2 countries, US and Mexico, and all the implications that that operation involves. So we have 3 types of financial impact for the use of foreign currencies. Is realized gains or losses. Who can explain this line to me? Don't worry, Andrea, don't worry. Just don't make it an habit.
Is it when you record the gain or loss that you get from the exchange rate of the transaction?
It's a gain or loss in a transaction. But what is the fundamental aspect to make it realized gain or unrealized gain? What is the difference between both of this? The unrealized
reporting.
When you have to report to certain date, it's very common to report on a monthly basis or quarterly basis for public companies. You have to do a revaluation of the foreign currencies in order to present those foreign currencies to market value. Okay, that revalorization or valuation from the foreign currency when you registered until the market value when you were reporting, it's an unrealized gain. Why? Because that's something that you haven't done. That's something that you haven't go to the bank and change the currency in order to effectively get the pesos or effectively get the dollars. It's just a valuation process in order to present your foreign currencies to market value. When it will be realized or gain or loss, realized when you effectively pay the vendor or collect your account receivable and you put it into the bank and the bank changes it to the currency that you want. That's effectively realized gain or realized loss. Unrealized comes from the process of doing the valuation process, revalorization process, in order to report things to market value. Okay, until here we are okay. Perfect. There is a third component. This is the third component that gets very tricky with students. The third component, it's called CTA, Currency Translation Adjustment. This is just a translation adjustment in order to present, guys, remember, unrealized gains comes from revalorization of your account receivable, accounts payables, and the money that you have in the bank from foreign currencies. You can have a customer right here in Mexico that operates in US and you charge him in US dollars, as we did in the previous example. When you do the revalorization, that's called unrealized gain or loss. Don't mix up with the currency translation adjustment. The currency translation adjustment will come from translating your Mexican pesos trial balance, or you know that from the trial balance, you will get your income statements and the balance sheets. You will revalorate right now, or you will do the translation from Mexican pesos to US dollars. Why? Because the shareholder is requesting it to you and the shareholder is based in US. So how will you do it? You have the Excel right now in here in front of you. How will you do it? You will apply the exchange rate at closure, at market value. It is kind of what we were talking about, the unrealized gain or losses. So what you will apply this exchange rate, you will apply it to something called monetary parties or accounts. You got monetary accounts. So I just explained to you, well, no, not explain, but I just write it down, what you will use for each account in order to do the evaluation. Oh, we have a new guest. Hello, hello, Arturo.
Hello, mister. How are you?
Welcome, Arturo.
Thank you very much, mister.
Let us see you, Arturo. Turn on your camera.
Give me 1 second and I will turn it on.
Okay, okay.
I'm just getting home.
Don't worry, don't worry. So take a seat, Arturo. Take out from your email tray an exercise that I just sent to you, okay?
Yes. Okay.
So guys, we will use, please start doing yourself the conversions. You have a trial balance in here. This is a trial balance. What's the first thing to do in a trial balance? To see if it matches to 0, okay? So what we will do, and this is a like kind of a real exercise, is start converting this Mexican pesos balance to US dollars. How will you do? Apply the exchange rate for monetary accounts. The monetary accounts are the ones considered normally or usually considered liquid accounts. Liquid accounts. What are the liquid accounts in your balance sheet?
Yes.
The current assets. Those are the liquid accounts, and the liabilities are the short-term liabilities. So apply that to the apply the exchange rate at closure market value to monetary accounts. Then you have the average exchange rate. It is the average of the exchange rate through the whole period evaluated. If we are measuring from 1st of January to 31st of January, we do an average of all the exchange rates at the closure of the day. And it's an average divided by 30, no? Per each day divided by 30. And the historic exchange rate goes to the non-monetary accounts. If this applies for the current assets and current liabilities, well, the non-monetary accounts are the non-liquid assets like fixed assets, long-term debts, retained earnings, and I will explain later why we apply that. So do it, please, do it by yourselves. If you have doubts, you have me, you have 5 minutes. Are you good to go, guys? Thumbs up when you finish, or raise your hand. Thumbs up, Andrea. Thumbs up. You're done? Yes? No? Anybody else is? It's done? Are you done, guys? Come on, it's 2 minutes. Marcelo, thumbs up. Awesome. Awesome, Emilio. Samantha, Joao. Okay. Wait a little bit. Arturo. Arturos. Ah, nice. Awesome. Thumbs up, Andrea. Pilar. Hmm. Samantha, Joao, good to go? Awesome. Arturo?
No, not yet. It's that I couldn't find the file, but I just did. But
Okay.
you can keep on going.
Okay. So guys, let's go. Let's go to the, how do you do the conversion? It's very easy. You go with the monetary accounts and you just had to identify the monetary accounts. So this is a monetary account. This is a monetary account. This is a monetary account. This. And the deposits, we can consider the monetary account, but maybe it should be in the fixed assets. We start with a problem in here. This is a non-monetary account. Non-monetary account, and we return to the monetary accounts. Suppliers is a monetary account. Other vendors is monetary account. Intercompanies payable is a monetary account. Tax payables, customer prepayments, and social equity. Social equity is not a monetary account. Not the legal reserve and the retained earnings. Can somebody, and I want to wait here, why is this not a monetary account? Non-monetary account. We start with our first problem, guys. Imagine that you have retained earnings from previous years, okay? From the previous year. So imagine that from those 300 US dollars that you are reporting, you reported 100 in the previous year. So what would happen if we use a different rate than those 100 that you reported? $100. If we use a different rate, you will change the retained earnings, right? You will modify the retained earnings from a shareholder that you reported that you retained him $100. So it comes to the first issue on the translation adjustments. You have to report exactly the amount of dollars that you told them that you owe them in the previous year and the amount that you retained it in the previous year. So that's why we can't use monetary accounts for the retained earnings, because you would be modifying the reported earnings from previous years. The other aspect is that the transportation equipment, most of the value of in a lot of companies, the greatest value comes from long-term assets. So if you're modifying the price of a whole, imagine that you are in Colgate Palmolive. You have as an asset the whole fabric, right? The whole manufacturing facility. And that's your biggest asset, because in there you have all the Colgate machines and all the automatic process, and that's your fixed asset. So imagine that you use monetary accounts for this conversion. You would be changing the values of the fabric each time that you report. So this is something very controversial, because IFRS lets you apply monetary accounts for fixed assets or long-term assets, guys. That's something that is very controversial. US GAAP doesn't allow it. It's there. It tells you, give me the specific exchange rate when you bought the asset. If you have a laptop, you have to report the specific exchange rate from the day when you buy the laptop, when you bought the laptop, okay? That's the difference between non-monetary accounts in the fixed assets, and that's the difference in the non-monetary accounts in the retained earnings, okay? Please don't get confused with those. In there we start with the discrepancy. So by the end of this, it's just applying the sales, the income statement. All these accounts beginning from the sales are income statement accounts. And what do we use for income statement accounts? The 18, okay, the average. Why we use the average, guys? Can somebody explain it to me? Why do we use the average for the income statement?
Because the currency varies in the period.
Yes. Go ahead. Go ahead. It's part of it, but close the conclusion.
Yeah, well, if the currency, for example, the Mexican peso fluctuates from 22 at the beginning of the month, and then the end it is at 18th, you can't use both of them. Like, you have to do an average and use that. It's logical, at least for me.
Okay, check this out, guys. The monetary assets are assets, or even the liabilities, the monetary liabilities are things that you have on hand. Like, I have my account receivable, or I have my US dollar bank account. If you do the evaluation or the revalorization process to market value, is because you have on hand $100 and you can exchange them at the market value exchange rate. Not like the retained earnings that we just talked about, not like the fixed assets that we just talked about. But the sales, where are you going to exchange your sales? The money that comes from your sales, you have it in the bank or in the account receivable. And that's what you revalorized at market value. What you want to present in your profit and loss statement is the nearest as possible as the conversion rate for the original transaction. If it varies along the whole month, as Emilio was explaining us, if you do an average, what you are doing is do a compensation or how can you say, so you soften the curve. So if you had at the beginning of the month a very high exchange rate and at the end of the month a very low exchange rate, by doing an average, you're presenting the closest amount that it could be translated to US dollars. That's why we use average exchange rate for income statement. Did I explain myself? Yes, everybody, thumbs up. Awesome. Did you get this result at the end? What happened to your trial balance?
There you have gains or losses.
We have gains or losses. ¿Quién descuadró la balanza? That's the foreign C translation adjustment. What would happen is that in order for us to make our trial balance match up to 0, we have to record something called currency translation adjustment. We're starting from a matched balance. It goes to 0. By translating it, by translating this matched trial balance, our trial balance doesn't match. Who can explain that? Yes, we know it's the currency translation adjustment, but who can explain it? Who has a guess of why? And this is an actual exercise. This happens if you have foreign currency. That I just taught you the last class that it's very common.
Maybe, I don't know. It's the only thing that occurs to me, but maybe because we are not dividing every number by the same number. It's like some of them are divided by like 19 or some others by 18.
That's the arithmetic. That's the arithmetic conclusion. Yes, totally correct. Totally correct. But is it really something just called? It's because we're just using different rates and that's it. Or does it have a meaning for you?
No, of course it has a meaning because each number represents the market value that you're dividing it into, or like the I don't know how to explain it. Like the moment of how to explain the value the currency you're translating it to has at a certain moment, because you're sometimes translating it to a value that was given or that will be or that is going on. I don't know how to say it, but something like that.
Yes, you're getting closer. I get you, Andrea. You're getting closer. I am sure that I can close your conclusion. But Emilio, speak to us.
Yeah, I have a question. Will that balance at the end change depending on how the currency fluctuates? I mean, we're talking about
Yes, of course.
maybe depending on how it fluctuates, it might be positive or negative. Like
Yes.
maybe in the period, yeah. So yeah.
Right now, everything sums $11. Okay. In order to match it up, I have to put negative $11 in the P&L because the CTA it's a P&L, not P&L. It's other comprehensive income account. Remember me the financial statements, guys. Tell me the financial statements.
Balance sheet, income statement,
Cash
the
flow.
Cash flow,
cash flow, and the comprehensive income.
other comprehensive income. Remember that the other comprehensive income was something that we can see below, and I can show it to you guys. Let's watch it because this might be a hard concept for some. We will see today Verizon. Yes, Verizon. We will see Verizon today. So Verizon annual reports. Oh yeah, let me show it to you. Sorry, I was not sharing, right? Share screen. Verizon reports, annual reports. Always the 10K to see the full version. You go to financial statements and supplementary data. And let me make it bigger for you so you don't get blind. Okay, first of all, consolidated statements of income, including subsidiaries. We will see consolidation in this class. It's matter of this class. Remember, we just talked about it very easy. We will do a consolidation process for this class. And it's kind of the hardest topic, huh? Net income. After the net income, we saw that from the net profit, the last account, it's always the net income. But after the net income, you see other comprehensive losses, net of tax, expense of benefit, other comprehensive income. And what do you see in here? Foreign currency translation adjustments. Okay. Unrealized gain and cash flow from hedges, more advanced. This is involving how to recognize the accounting of derivatives, which is another topic and not for this class, but I can explain it to you. Unrealized gain or losses from marketable securities. And so unrealized gain or losses for this type of hedges, marketable securities, and retirement plans are in the other comprehensive income. Those are not the same as unrealized gains from or unrealized and realized gains. Those come in here. Let me see. They are usually on these three lines: before operating expenses and operating margins. Okay. They are in the RIF, in the resultados integrales del financiamiento, where you have interest expense and interest income. You have realized gains and unrealized gains. Realized gains or losses, or unrealized gains or losses. Those are in here. Those are in here, not in the other comprehensive income. What you do have in the other comprehensive income is the foreign currency translation adjustment. And why? because it's something not related to the company operation, but it has an impact on your finances, and this is the impact that you need to see and understand. So let's get back. How do we measure that translation adjustment? In this case, it will be an income because it is part of the profit or loss statement in the other comprehensive income part section. And if you have a negative in the profit and loss, it is an income. In this case, you are winning for the revalorization of your historic or the non-monetary accounts. You could be winning or losing value of the non-monetary accounts. That is the impact that we are seeing. In this case, we are winning.
So teacher, if it had been negative, the result, we would have had to.
The result is negative. Oh,
No, before we adjusted it. Like if it had shown a loss, like -11 in there, we would have had to register it in the other
11.
side.
You would have to register 11.
In the same side, right?
No, it would be an expense rather than an income. It would
Okay.
be a loss.
Yes.
If it
Okay.
has an impact on your profit and loss statement, that's why you have to acknowledge, and that's the important message. You know that you have a translation adjustments in your profit and loss statements. So I will teach you how to hedge this type of transactions. You can hedge them. That's why in here you have cash flow hedges. You can hedge with your suppliers with the synthetic derivative. You can go to the bank and do a forward contract between you and the bank. You can go to an exchange Casa de Bolsa. I don't know how it's called. You can go to a Casa de Bolsa, go with an executive, and the executive will do the movements for you. And you can go yourself to the Chicago Mercantile Exchange and operate derivatives if you have a certification. Okay. But the most common is you have to realize what is your position. We will see it. What is your position? Determine the level of risk, and you determine with your shareholders, with your board of directors, what amount of coverture or hedge. You don't fully cover your whole position. You usually determine if you will cover yourself with 50%, 60%. That's something arbitrary. We usually don't cover the 100% of the risk position. The purpose is not to eliminate the risk, is to mitigate it. Instead of losing 1,000, you lose only 500. Okay. So guys, are we okay with the translation adjustment? Awesome. Can you deliver that as part of your homework? No, why not? Put your name to it.
Just kidding. We can.
I will make it available so you can upload first homework. or I can leave you more homework. Whatever you want. You negotiate.
What about none?
Nothing comes for free, my man, in this world. Mm,
So what's your offer? What would we need in order to get no homework?
More jokes from my pool.
sorry, to convince the Anahuac system that we don't need homeworks. Okay, guys, so let's continue with our presentation. So take a break, 10 minutes. We see each other at 7. Take today's goals, guys. It's understanding the reasons for foreign direct investment, which is the topic of your of the your whole bachelor's degree. Understanding the challenges or difficulties for foreign investment, and understanding the reason for accounting diversity. Okay, so guys, first of all, please tell me, what is foreign direct investment? What detonates the foreign direct investment? Why is Mexico one of the top countries for direct investment, foreign direct investment?
Maybe because of the potential of the country, and maybe that it's easy.
Okay, you determined that the potential of the country is okay. We have to do a whole process of assessing that. We will touch some bases regarding that issue, but okay, you established that Mexico, it's okay for your investments. So how would you detonate that investment? What would you do?
Maybe also that the workforce is cheaper, maybe costs are lower.
Awesome, awesome. Those are the reasons why. And we will review some of the reasons. But first of all, how would you inject that foreign investment? You are in the US. You established that all that part, that it goes well with what you want for goals, and the cultural aspect of Mexico is okay for you. So how would you detonate that investment? What would you do?
There are different ways. For example, one is, I don't remember the correct terms, but I remember we learned them. Which one could be like a merger, or you can acquire another company. You can enter as a direct export, or some middlemen. There are many ways.
Awesome, awesome. It would depend on the assessment of the control that you also want to have. Obviously, the just going as a supplier and Armstrong length, you can literally like just go with supplier and purchaser agreement, and that's it. If you want more control, you do an acquisition. If you want to have 100% of control, you go with a greenfield investment. What is greenfield investment?
When you have to build like from zero.
Exactly. That's a greenfield investment. Okay, guys. So basically, I just stated that we just stated how you start for indirect investment. It depends on the ownership and control that you want to establish. As I told you, you can go with no control at all, arm's length operation, or go fully with 2 ways of acquisition. So you can acquire and control that company which is part of the merchant acquisition process. You can also go with a merge, but the merge gives you less control than an acquisition, or go wide to the greenfield investment with no operations in foreign currency, in the foreign countries. So the reasons why do this? Why would you do a foreign direct investment? Now we start with the reasons, the goals, the strategic aspect. I always encourage you to think strategically. It's not an accounting class. This is strategy. So tell me, why would you, or what are the reasons for foreign direct investments?
One of the reasons is the one that Sam mentioned, and another but this is strictly like on the manufacturing aspect. It's that for example, it may be closer to your targeted market. For example, I don't know. Oh yes, like a lot of the car manufacturers make manufacturing plants in Mexico in order to sell them to the US and Mexico and America itself without the traveling costs.
But would you think that that's the reason? I get you. That's that's something that detonates for indirect investment. But what's the reason behind of automotives establishing their manufacturing facilities in Mexico?
Make more money.
To make more money. Actually, it's what Andrea said. It's a cheaper manufacturing labor cost. That's one of the reasons, but we have a lot of reasons, guys. So start with the, how do you say, la lluvia de ideas? Tell me more. Yes. Lower manufacturing labor cost. It's one of the main reasons. What else is?
Could it be like, I don't know, but the legal side of Mexico is really easy to, I mean, the transactions are very like late and all of that, but you can like bribe and stuff.
No, Andrea, you don't bribe people in this class. That's not a reason.
No, I thought maybe.
Maybe in that country you pay like lower taxes or something like that.
That's a good reason. Excellent. That's a great reason. The lower tax base, it's a great reason. What else is, guys? What else is? You have to think.
The currency,
What?
the currency that you don't know. This, what Samantha said made me think that.
Let's go with the automotive, with the automotive example.
Yeah.
What would you like think in your reasoning or the explanation that you're giving us is to enter for a new currency? That wouldn't make you more risky because you're managing more
All right.
currencies.
Yeah.
What would you think about technology, guys?
Technology is really accessible in some places.
Yes, in some places you said it. You can have why is India right now very popular regarding IT?
Cheap labor, and they have a good electric infrastructure.
More than electric, there are a great development, software development approach. So it's cheaper to have developers in India, and they are great developers. So it's Mano de obra calificada. It's one of the main reasons. Obviously, acquire technological and managerial know-how. Increase sales and profits, guys. You enter new markets and increase profits. What else is, guys? What else is? Think strategically.
Maybe the geographical position.
Why it would benefit you, the geographical position?
I mean, I don't know like what would be the main strategy for the company who wants to be in Mexico, but for example, the ports, and they have like two oceans, you know, and all of that. So maybe they can.
I think you're elaborating a good strategy, but at the end, I think we can summarize it because that strategic geographical aspect can benefit you for less costs for logistics or increasing markets because you can ship them. Okay. Arturo, go ahead.
The geographical position, I was thinking the lower transportation costs, and also it could be closer to the raw materials that may be needed.
Yes, yes. As Andrea says, I also think about it, and I think it's a good reason. We can gain a foothold regarding the geographical position. What if I'm in Venezuela? I'm a company in Venezuela. Do I have a treaty with the US? What if I want to benefit from the US treaty with Mexico, United States, and Canada? We have a US treaty, right? To protect domestic markets, guys, if we weaken international competitors by entering the competitor's home market. Oh, the Expedia loves to do that. Oh no, I need to not record this. He's the biggest travel agency, so if he sees somebody racing, here, go with your bag of money and shut up. He's removing competitors from the market. Okay, guys, so here are some of the main reasons. It's increased sales in profits, enter rapidly growing or emerging markets, which is a growth rate that is higher than local markets. Reduce cost, obviously, gain a foothold in economic blocks, as we just said it. Protect domestic markets and acquire technological and managerial know-hows. Like if I want to open a software company, I can get a huge leverage by establishing an office in Silicon Valley, where we have great developers, no? So here are some of the main challenges for foreign challenges and difficulties for foreign investment, guys. It's not just thinking, oh, I need to open a new office so I can start the US market. You will have to think in financial reporting for foreign operations, international income taxation, international transfer pricing. We will see them all, okay? Performance evaluation of foreign operations, international auditing, sustainability reporting. So What is this the challenge regarding financial reporting for foreign operations, guys? What do you think about it? Yes, I will explain it, but think.
Maybe like, for example, I don't know, but maybe the US GAAP and the NIPS are different and you have to take that into account to report.
Yes. Yes. Let's see it. Steps in reporting for foreign operations, conversion from local to US GAAP or US GAAP to another currency. What else do we have? International income taxation. Why international income taxation? It's a challenge.
Because countries have different treaties between themselves, and also the receiving country doesn't know how to tax, like if you don't specify, so it's a lot of hassle to do that.
Yes, totally correct. Totally correct. Where do you think it's more difficult, the taxation, in Mexico or in Germany?
I would say Mexico,
Why?
because Germany has the Union Treaty. So it's fairly easy to import and export those countries between the European countries. Meanwhile, to my knowledge, Mexico's only big treaty is the USMCA.
Okay. Okay, guys, but obviously what you have to take care of, and yes, Arturo, you were correct. What you have to take care of is that you have different taxation methodologies. So obviously you would need at least an international tax expert. Expertise in international taxation is needed. This last. So international income taxation is how much taxes to pay in local and home jurisdiction. Double taxation treaties, as just Arturo said so. Like here in Mexico, you only pay taxes in one country or the other, right? Somebody from here, it's a US citizen? No? And anybody from here that it's not from Mexico? Arturo?
I'm not. I mean, in Ecuador, taxes are horrible for everything.
Why?
Due to the last government, which has had like this idea that Ecuador should grow with their own products, but Ecuador doesn't produce, for example, good quality cars or technology. So products just.
Okay. The interesting aspect in here is that, do you know if Ecuador has an international or double taxation treatment with Mexico?
Ecuador almost doesn't have. I think the only one it is part of is Mercosur, which doesn't help it like at all.
So the important aspect in here is, if you have Mexican accounts, bank accounts, do you need to report Ecuador tax, the tax IRS?
I'm not sure about it, but it wouldn't surprise me if that is true, because that's why many companies left the country and many companies don't want to get into business in Ecuador.
Okay.
It is a very difficult place to enter to.
Okay. Well, I wanted to explain because in Mexico, we have a double taxation treatment. And what it means is that you have to pay the sales tax in the country where the operation has been originated, okay? But the income tax, for me, like being US citizen and Mexican citizen, I have to pay part of my taxes in here in Mexico because all my economic benefits come from Mexico, and that's rated at 30%. But in the US, if I overpass certain threshold, that threshold it's taxed at 35%. So if I overpass that threshold, I need to give to the US that 5% that I have not paid in Mexico. That's what the double taxation treaty tells you. Did you knew that? No?
I had no idea.
Well, now you know. Now you know. It's cultural knowledge. So the important aspect is that obviously if you will start international operations, you would have to acknowledge the tax treaty of that country and how it has an impact in your home country. So tax treaty provides relief from double taxation sometimes. We can enter obviously to the tax paradises, but it's not part right now of the you know that I like that subject. But objectives to legally minimize taxes in foreign countries and home countries, obviously, from a legal perspective, tax paradises. Maximize after-tax cash flows. Oof, there are a lot of, my friend. There's even an economic study regarding that. A whole institute, and they evaluate all the tax paradises because there are like 50. Expertise in international taxation is needed. Okay, perfect. Yeah, we just established that. So international transfer pricing, guys, come on, tell me this one. Who can explain that one to me for the fourth time? Chirp, 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 chirp. Come on, guys. International transfer pricing.
Maybe like the price you're gonna sell your product at, considering the taxes you have to pay in that other country, so that you don't lose a lot, or you know what.
Can you rephrase that to me?
Yeah, that maybe, what did I say? Yeah, that consider the prices that you're gonna sell your product at, or your service, considering the taxes of that other country, so that you don't have like negative consequences out of that.
Anybody else's that can complement Andrea? What are international transfer pricing? We explained it last week.
It was something about when
I will draw it to you. I will draw it to you like
when one company sells the good to another division.
yes, exactly. That was the example. Have to draw it again to you guys. What is this? My beautiful drawing. So in here we have Tesla Motors, right? It costs to them $80 per car If you want 80,000, okay, 80. And they sell and the costs, oh, sorry. Sale and costs. So we have a profit margin of 40K. So our good friend Elon Musk figured out that if he implemented a company, let's see, in Aguascalientes, so we don't use the Mexico City. Tesla MX, okay? So this little dude is so smart that he decided that the cost for the Tesla in Mexico is 40K. Why? Because the cheaper labor, okay? So this dude decided to sell to this company at the price of 30K. So imagine that right now, as this is the first version, right now the second version goes from sales of 100K per vehicle to a cost of 40K, no, 30K per vehicle. Sorry. And he was so smart that this is not the only economic benefit, because right now he increased his margin from 20% to 70%. But he also has an economic benefit because he has fiscal losses. Who can explain these fiscal losses, why it's an economic benefit?
I don't know, but maybe because you can invoice it.
The fiscal losses grant you the benefit that if you have the next year, you have 10K of taxes to be paid, you can use this fiscal loss in order to avoid paying the next year. That's an economic benefit of the fiscal losses. So he just not even, he just increased from 20% to 70%, and he has an economic benefit. Yes, but the government is not stupid. Like, oh man, yeah, Mexico has all the fiscal losses, and the US is receiving 30% of all his margins. Do you see the economic impact for Mexico? So the Mexican government, and the transfer pricing is implemented in all the governments, guys, okay? Between whom? Between related parties. That's the first definition, related parties. They have to be related parties. And how do you determine related parties? Because they have a position of control and they have capabilities, decision capabilities in the boards of direction, the directors boards, okay? Or you're basically a shareholder that has 51%, 50 plus 1%, as easy as that. So the Mexican government established that they are not allowed to sell below the cost. What they determine is that, man, you have to find a market value. There are different methodologies, okay? There are different methodologies, but the important aspect is that you need to find the market value. So at the end, we establish a little bit of economic benefits in Mexico, but at the end, it also benefits Tesla in the US. So at the end, it costs 50K rather than 80K, and he won 30% of margin. Okay. But how to price this part, this market value of things, it's called transfer pricing. Okay, guys. Are we good to go with the transfer pricing for the fourth time? Yes. Awesome. I can explain it the fifth time, but come on, guys. Make my day. So if you have a related party, you now know that you have to, in order to do operations between both, you need to have, or must have by law, a transfer pricing study. Even for loans, be careful with it, because you, some people believes that it's only if I need to buy them cars or if I need to buy products. No, even for loans, if you have to give loans to your intercompany or to your related party, you must have a transfer pricing study. You have to determine a market value interest rate. Let's share. Transfer pricing. Oh, let's see what it says. Is issues for multinational companies making intercompany sales. We just said it. Companies' use of discretionary transfer pricing, price negotiation between buyer and seller not feasible due to tax rate differences. Okay, but obviously, as you saw, the company shifts profits from countries with high tax rates to countries with low tax rates. Same principle that in tax paradises. So countries regulate international transfer pricing to ensure companies pay their fair share for local taxes. That's the whole idea of transfer pricing, to pay their fair share for local taxes and not take all the economic benefits to another country. So performance evaluation of foreign operations, making sure units achieving their objective. Guys, it's very hard to align the whole teams, and we will see why. We have some challenges in there. So evaluation is through periodic reports on individual units performance. And there are some issues in the evaluation, like translation from one currency to another, inflated price due to transfer pricing. International auditing, guys. Obviously, I think that it's self-explanatory that you have to do an internal audits as part of your control assessment. Who sends the internal audits? Usually it comes from the finance team, but it doesn't mean that you can send internal audits from operative departments or from IT departments. The important in here is that obviously you have to comprehend that even the internal audits have challenges. And I wasn't an auditor, but I was a controller, and I assessed this part. I check it because yes, there is a lot of issues. The first of all, it's the difference in language and culture. That's the first of all. So then you have the difference in accounting standards and auditing standards, because everybody wants to follow their standards. But sometimes they don't know the international standards and what is the corporate governance. So these are part just of one of the main risk factors when achieving international foreign investment. So the cross-listing, what is cross-listing, guys? Cross-listing, anybody? What is listing in foreign stock exchanges? When you go to the stock exchange, right? When you list, when you do an IPO for your company, well, it's not the same in cross-listing for foreign stock exchanges. You would have to fulfill the requirements for the next stock or the foreign stock exchange. Like in US, they manage US GAAP. Maybe if you want this company move it from the US and do a foreign investment in Europe, you would have to modify your accountancy in order to comply with IFRS. Sustainability reports, guys. What is the sustainability report? Come on, guys, come on. We're almost done. Sustainability reports.
Perhaps it is seeing how sustainable is the growth of the company.
Do you remember what areas involve sustainability?
Well, I have a question. Are we talking about financial sustainability or like environmentally sustainable? Because I don't know if that made sense, but like
the sustainability covers the environmental area, but
oh,
that's
okay,
for
it's a,
one area.
yes, it's that when you said sustainable, I was thinking like of sustained growth.
No.
Okay.
Sustainability reports. Haven't you seen sustainability reports, guys?
No.
I did teach
Yes.
you that. Very fast. Let's watch one. And we have Google in here. So, and why is important? Because right now in some Europe countries, sustainability reports now are obligatory. These reports are obligatory in some countries of Europe. So be careful with it. You have to consider it also. So just let me share screen. Yes. And remember, guys, sustainability strategies gives you strategic advantages. It's very important to consider sustainability. Okay, where you can find the sustainability strategies. Take a look. This is the prioritization matrix, materiality matrix, or prioritization matrix for key issues regarding sustainability. So we can see that the greatest impact on Ford and the greatest influence on stakeholders' decision-making, it's the number one, which is modifying electrification and alternative fuels, finding alternative fuels and batteries. That's the key aspect for the company Ford regarding sustainability on the environment area. We have economic, and we have society, and we have governance. This means that they are covering and taking care of all the aspects, because if you will establish one fourth company in here and suddenly it has corruption, it has bribery issues, he doesn't pay taxes, at the end, what is the economic benefit for the foreign direct investment? This ensures that they are taking care of all the stakeholders and shareholders aspects. And that's why it leverages and gives you a competitive advantage to take care of your sustainability, guys. Learn about this topic. I encourage you to do it. So that's okay for that part. Let's move on. Okay, and obviously global accounting standards. I don't have to say more than that. So okay, in here I have something wrong in the presentation. Let me see it. How can I solve it? Just give me 1 second, guys. I will share it to you. Let's don't have a break, guys, so we can finish early, no? We're just 15 or 10 minutes away. Okay. Okay, yeah, I know what can I do. Just give me 1 second. So I'm fixing this part. That's it. Awesome. So we will start with the issues regarding the accountancy aspect. Obviously, that's our topic. That's the first issue regarding global accounting standards that we need to solve. Is that we have in this position Vodafone. What is Vodafone? Guys, what is Vodafone? Nobody knows it? Vodafone is a very known, prestigiously known company of communications. They actually branded McLaren for a bunch of years, no? When Checo Perez was in McLaren, Vodafone, no?
Yeah, I know about it, but I didn't know it was communications.
Yes, it's communications. And in here we have Verizon, also communications. So let's start reviewing the differences between both accountancy aspects. So how do we see it? It's a consolidated statement for Vodafone of financial position. Can you tell us, Samantha, help us with how does it start?
What do you mean?
It starts with the non-current assets, right?
Um,
And what is the most liquid accounting here?
Goodwill?
The most
what?
liquid, the most liquid.
Oh, in the non-current assets?
Yes.
Or, okay. I
Gotcha.
mean, I thought they were, I thought they were organized by liquidity. That's why I
They are
said that.
organizing liquidity, guys. So who can help her? What is the most liquid account in here?
Cash and cash equivalents.
Yes, of course. But in the non-current assets,
Ooh. I think
So then
property,
trade
plant and equipment.
another.
Trade
trade and other
other
receivables. Yes. So we can see that they are start from the less liquid account and move downwards to the most liquid account. And this is a UK-based company, okay? What's the difference between the US-based company, Verizon? This is what they teach us in the accounting system. You start with the most liquid and you put the less liquid at the end. We start with the differences in here. What happens with the total equity and liabilities? What are provisions? Provisions. Who can tell me
don't
what
know
are provisions?
what would that mean in a communications company.
Remember always that a good way to read the financial statement is to have the complete statement. So you can go to the note 16 or to the note, yes, to the note 16, and it explains what they are considering as provisions, okay? But the important aspect is that they have provisions for employee benefit obligations that this is how they are called in US. That is a provision because you have to make a provision regarding that, like in Mexico, if you have more than 5 years in a Mexican company, you can request something called antigüedad. So by the 5th year, the company is obligated to do a provision of that liability because they have to pay it in theory. But the important aspect in here is that you now have established that there are differences in the presentation of the accountancy aspect, as well as you are watching, there are different account names. So you have to consider that part of the, this is part of the accounting diversity, which is one of the main challenges of what we will see. Okay, so reasons for the accounting diversity, first of all, the legal system. Obviously, the legal system, guys, the common law is something that we have seen a lot in the US. The common law means that the legal system, it's more towards like in the when you go to the jury in the US and the judge makes a sentence, they can use that sentence in other cases, replicating that case. Like if you use that sentence for that case, you can use it for this case because it's the same. It's called common law because you don't have that much established terminologies as the code law, like the tax law or the audit professions, accounting academicians. The code law is like the code for the accountancy aspect, okay? So the basis of taxation, it's another reason of accounting diversity. Like in USA, we have financial statement adjusted for tax purposes. Learn this, guys. You have financial information, financial statements, and you have tax statements. You have double accountancy in US and Mexico. That's the same. You have financial statements which follow a financial criteria, and you have tax statements that follow a tax criteria. In Germany, for example, they use the financial statement for both. So they have the same basis of taxation. That's why we can, it gets more complicated regarding the accountancy aspect. There is accountancy diversity. Providers of financing, for example, in other countries that are not US based, and that happens a lot in Mexico, guys. In Mexico, Mexican economy, it's controlled by families. It's commonly known, or there's even studies. The ones that inject the most economy to the to obviously to all the economy aspects are families here in Mexico. That represents 70% of direct investments in Mexico. But what it means is that it's less regulated than public companies, because if you go public like in US, which is way easier than in Mexico, you can have access to public funding. That means that the shareholders, as it's a larger aspect of shareholders, they demand to become more, to have more transparency. You need to follow the public guidelines, rather than if you are financed by families and you ensure a good relationship with them, they are more like softer with the rules for providing financing, guys. That's another reason for accountancy diversity. The code law, come on, guys. The code law, I don't need to say it. Obviously, it's related to, well, no. Hey, this is not the forget the subjects. Inflation, it's another thing. The common law and the code law is something that we just explained. The inflation, obviously, it means that, like, for example, in Latin America, the inflation was huge in the 80s and in the 90s, but in the US, it was non-existent until this year. So we will do re-expression of inflation in this class. It's very difficult. No. This one is very easy. We will have to do a re-expression. I just brought it down, the process. Adjusting accounting records for inflation results in a write-up of non-monetary assets. Remember what are non-monetary assets?
Intellectual property.
An inventory, yeah. We didn't have inventory, that's why we didn't saw that one. Inventory is a non-monetary asset. And why? Because it depends on the valuation method that you have. Also, remember that you reported the inventory at certain price. You use the historic price in the inventory. Well, I don't want you to get more confused right now. So political and economic ties. This means like there are some related topics from countries, like Mexico has great influence from the US. Like from England, Jamaica has great influence that you can find in Jamaica. So we can share accountancy aspects from them. That's why when we teach accountancy, like in the Anahuac, we teach the US-based method. Okay, and this is the important aspect, guys, that I'm telling you, that these cultural aspects makes it very, very hard as part of the direct investment or foreign direct investment, the culture. Let's do the final exercise about the culture, then the next class. But it's basically Hofstede's establish a cultural framework to establish how the culture that you are entering works. Like if you want to go to Japan, you can evaluate the Japanese by these dimensions: the power distance, the collectivism and versus individualism. Let's do that part. Like collectivism versus individualism. US versus Japan. What do you think US prefers the most, collectivism or individualism?
Individualism.
Yes, why?
Maybe because their culture makes them more, you have to be more independent of yourself and not depend on others.
And they compete a lot and to be the number one, and that's more towards individualism. And Japanese are towards collectivism. Who can explain it? Why?
Historically, they have been a very comunidad comunitaria, because of their geographic position, and they often suffer a lot of natural disasters, so they tend to be very looking out for each other.
Awesome. So this framework helps you understand that cultural challenge that you will have by entering to this country, because by establishing the level that you have, you have like a template, and I'm telling you because I told you that I did this in this matrix in my master's degree. And in order to go to another country, this will help you understand the culture. So in order to avoid some deficiencies, like maybe if you do some, how is haces algún gesto and it's considered offensive in the other culture, you can at least start to developing this cultural aspect to get more related to the culture, to take care of these important aspects, so you can be prepared to arrive to that culture. That's the main reason of why we created, or why Hofstede created this cultural dimension. It's a nice assessment that we can do together. I just wanted to briefly explain it to you because I want to do it with you, so we can, like right now, compare the US culture regarding the Japanese. How would they try the Japanese? How would they treat a US citizen when they arrive to Japan? I don't know. It's a good exercise to do. So guys, that's it for today. Thank you very much. Thank you very much, guys. Please send me. Oh no, I will have to, I will give you the homework available so you can upload it. Upload your CTA exercise, okay? And guys, I do want to go on campus the next session, okay? So let me